Welcome back to the deep dive. We are jumping straight into a date, really now burned into crypto history, 1011. If you were following the markets then, you know this wasn't just some like routine dip. This was the biggest single-day liquidation event ever.
That's absolutely right. I mean, when you look at the source material, the sheer scale is, well, it's unprecedented. So our mission today really is to unpack this $19.3 billion event. We want to figure out the mechanics, why it happened so incredibly fast, and, you know, who won and who lost in that massive wealth transfer.
Yeah, and the contrast is just stark, isn't it? That's what makes it so compelling. On one side, you've got, what, over 1.6 million traders completely wiped out, liquidated, gone. But then you have these other players, the whales, reportedly pocketing up to, what, $200 million overnight?
Exactly. It's a brutal lesson in modern finance, honestly. And we're going to try and break down how something like that can even happen.
Okay, so let's set the scene. To really get the shock, you have to remember the mood before 1011. This wasn't gloom and doom. It was peak excitement, right? Bitcoin had just hit a new all-time high, around $126,000.
Precisely. And look at the big bank Standard Chartered talking 135K targets, JP Morgan even higher at 165K. Total optimism. The sources basically say that high point, that peak confidence, that was the start of the abyss.
And then the drop, it wasn't slow, was it? The sources emphasized the speed.
Not at all. It was incredibly fast. Once selling started, it just cascaded. Bitcoin fell, what, over 10% in just 1 hour? Over the full 24 hours, it was down about 16%, bottoming out around $150, $500. A huge move.
And if Bitcoin caught a cold, the altcoins got pneumonia.
Oh, absolutely. Ethereum dropped 22%. Solana got hammered, down almost 32%. But the really terrifying numbers, the ones that show the pure panic, were in the smaller altcoins. Sources talk about multiple small coins dropping 80%, some even 90%, just evaporated in the short term.
And that level of destruction, especially in the smaller caps, that's what made 1011 different from past crashes.
Yeah, analysts pointed that out. Compared to, say, the 312 or 519 crashes, this altcoin wipeout was far, far deeper. It just created this void, a liquidity vacuum. Prices just plunged because there were literally no buyers left at certain points.
Which leads us straight to the leverage issue and those mind-boggling liquidation numbers.
Yeah.
CoinGlass confirmed it. $19.3 billion gone. That's the biggest single-day liquidation ever recorded, right?
Correct. Highest ever. And crucially, look at who got liquidated. $16.81 billion of that came from long positions, people betting the price would go up. Only about $2.5 billion came from shorts. So the market was incredibly tilted, over-leveraged, long, very fragile.
It's hard to even grasp that scale.
Yeah.
The sources mentioned one specific loss, a single $203 million liquidation on Hyperliquid. Just one position.
Just one massive position, yes.
Right.
And all that stress immediately hit the collateral system. Stablecoins, staked assets, they started to wobble. Things like Binance's WBETH and BNSOL saw temporary depegs. BNSOL was particularly bad, fell from over $200 down to like $35.
Wow.
But the real drama, the systemic stress test, according to many analysts, was USDD.
Ah, yes, the new generation stablecoin. What happened there? Because that seems key.
It absolutely was. In the middle of the chaos, USD plunged to $0.65. That's a 54% depeg. 54%.
Unbelievable for a stablecoin.
It recovered, yes, but that moment of intense fear was critical. It directly triggered more liquidations because so many people were using leveraged USDD as collateral. And this wasn't just contained to crypto, right? The shockwaves hit traditional markets too.
Yeah, the NASDAQ fell 3.5%, S&P 500 down 2.7%. Even crypto-linked stocks like Tron dropped 14%. Shows how interconnected things can get when that much capital moves that fast. Okay, so $19.3 billion evaporates, markets hitting all-time highs, suddenly collapse. The obvious question is why? How did this happen? Let's shift from the what to the why. And the sources suggest, well, it's not just one simple answer.
No, definitely not. It seems to be a convergence, multiple factors hitting at roughly the same time, which, you know, makes understanding it really valuable for you listening. It looks like a mix of big picture, macro fears, and some very specific mechanical flaws within crypto itself.
All right, so let's start macro. Theory 1, geopolitical tensions. What was the idea there?
Right. This comes from analysts like Firex and the data firm Santiment. They pointed towards growing market anxiety about potential new U.S. tariffs on Chinese goods, specifically mentioning possible actions from former President Trump's side.
And Sentiment saw chatter about this increasing right before the crash.
Exactly. Their data showed online discussion about U.S.-China trade tensions spiking just before the sell-off began. The interpretation is that big players, maybe fearing a wider economic slowdown from this, saw it as a signal to de-risk quickly. And just to be clear, we're reporting this analysis neutrally, just conveying what the sources said.
Got it. So macro fear might have been the spark. But what about the engine of the crash? The mechanism inside crypto that made it so violent?
That brings us neatly to Theory 2, which comes from Arthur Hayes, the BitMEX co-founder. He focused squarely on cross-margin accounts on the big centralized exchanges, the CEXs.
Okay, hold on. Cross-margin. Let's just quickly explain that for listeners compared to, say, isolated margin. Why is cross-margin potentially more destructive?
Great question. It's crucial. Isolated margin means if one trade goes bad, only the money you put up for that specific trade is at risk. Cross margin. Well, it uses all the money in your account as collateral for all your open positions.
Okay. I see where this is going.
Right. So when prices started plummeting, the exchange's automated systems didn't just liquidate the one bad trade. They started force-selling everything else in the account, potentially even profitable positions, to cover the margin call on the losing one. Hayes argues this created a massive destructive domino effect, especially hitting the altcoins linked as collateral.
So that mechanical cascade then fuels a liquidity crisis, which leads to Theory 3, market maker failure.
Precisely. Theory 3, highlighted by the analyst Bugs Bunny, suggests the market makers, or MMs, were simply overwhelmed. Remember, MMs provide the buy and sell orders that keep markets flowing. The analysis suggests they didn't have enough capital or the right hedges for an event this extreme.
And their reaction made the altcoin crash even worse.
Directly, yes. As the selling intensified, MMs had to protect themselves. They focused their limited capital on providing liquidity for the biggest assets, Bitcoin, Ethereum, the Tier 01 projects. To do that, they had to pull bids, pull their buy orders from all the smaller Tier 23 coins. And that's why you saw those insane 80%, 90% drops like IOTX going almost to zero. The MMs left, and there's just nothing underneath, no buyers.
Wow. And that vacuum connects back to the USDD stress we talked about. Theory 4 puts the stablecoin DPEG right at the center of the leverage problem.
This one's quite specific and technical. An analyst named Hanbalong Wang pointed out that USD would have this attractive 12% yield or subsidy. This apparently encouraged a huge amount of circular lending. People were borrowing, using USDD as collateral, maybe borrowing more against it, amplifying leverage.
Okay, so walk us through that amplification. If I'm using USDD as collateral and suddenly it drops 54%, what happens to my position?
It's a double whammy. Your position is already losing value because, say, Bitcoin is dropping. But simultaneously, the collateral you posted, the USDD, is also collapsing in value by more than half. This absolutely crushes the position. The source material even mentioned traders who thought they were safe, maybe just 1x long, still getting liquidated because their collateral value vanished.
A perfect storm then. Macro fear ignites it, exchange mechanics accelerate it, market makers flee, and then a protocol design flaw multiplies the damage. Any other contributing factors?
There's a fifth point, part of a broader analysis by Yi Lehua, looking at a general liquidity drain leading up to this. He mentioned several things. BTC hitting resistance, maybe money flowing into booming U.S. tech AI stocks, rising interest rates in Japan. But one point really stood out, the suggestion that the meme coin frenzy over the preceding months had gradually sucked liquidity away from more established altcoins.
That's fascinating. Kind of ironic, right? The chase for quick, high-risk gains in meme coins actually made the broader altcoin market weaker and more vulnerable to this kind of systemic shock. Okay, so if $19.3 billion was lost, that money had to go somewhere. It was a transfer. Let's flip the coin. Who actually profited from this chaos?
Well, the sources immediately highlight one particular player, the so-called BTC OG whale. This entity or group reportedly put on a massive short position, like a 10-digit short order, the day before the crash even started.
The day before, wow. That's either incredible timing or, as some sources speculate, maybe suggest they knew something was coming, like big institutional selling.
The timing is certainly suspicious, let's put it that way, and the outcome was spectacular for them. Reported profits are in the range of $160 million, maybe up to $200 million, earned in about 30 hours. They apparently closed most of the short right near the bottom.
Incredible. Any idea who it might have been?
Pure speculation in the sources, really. They threw out names suggesting possible links to maybe Trend Research, who reportedly made $300 million shorting ETH around the same time, or perhaps Bitforex's co-founder Garrett Jin, but it's not confirmed.
Okay, so that's one type of winner, the big, potentially pre-informed short seller. But there was another group too, right? The ones who bought the dip?
Yes. The spot buyers, the ones who were either awake, had cash ready, or maybe just got lucky with some extremely low limit buy orders already sitting there.
They must have seen some unbelievable prices flash up.
Absolutely insane arbitrage opportunities if you have the nerve and the capital. Like we mentioned, WBETH briefly hit $430. BNSOL was down at $35. And remember, USED, it touched 62686 cents. Buying that was basically a guaranteed profit once the peg inevitably recovered, assuming you acted instantly.
Talk about a test of nerves.
Yeah, the stories are wild. Sources mentioned a streamer, Hong Kong Doll, apparently made $2 million, and another KOL, Vita, disclosed an $8 million profit overnight.
It really rewarded being prepared and, frankly, being brave enough to buy when everyone else was panicking. Now, interestingly, it wasn't just individuals who won. Some of the actual protocols, the infrastructure, profited too.
That's right. And perhaps surprisingly, Ethena, the protocol behind USDD, actually came out ahead financially.
Wait, how? Their stablecoin depegged by 54%. How did they make more money?
It's counterintuitive, yeah. But according to their statements, the extreme volatility meant the futures contracts they used were trading way below the spot price. This difference apparently generated unexpected additional revenue for the protocol during the chaos. It actually increased their collateral reserves and strengthened them financially, despite the temporary panic around the peg itself.
Huh. Okay. And Hyperliquid, the exchange where that huge $200 million liquidation happened, they must have done well.
Very well. They reported a $40 million profit for that single day. Their platform's interest rate, the APR, apparently spiked something like 190% briefly because of all the liquidation fees and trading volume. It just underlines the old saying, right? In a gold rush, sell shovels. Or in this case, run the leveraged exchange. Hashtag outro. So if we try to pull all this together, everything we've covered about 10-11, I think the most stunning thing is just the sheer speed of it all. The sources keep coming back to this. It took maybe only 2 hours for nearly $20 billion to effectively change hands. That completely rewrote the financial situation for millions of people instantly. It's the very definition of a massive rapid wealth transfer.
Yeah, it's breathtaking. And the final takeaway, maybe the core advice from the analyst looking back at this for you, the listener, it's that the market isn't necessarily fixed yet. Liquidity, especially on weekends, can still be really thin. So the advice is simple, really. Hold on to your bullets, manage your risk, keep some powder dry, because you have to survive these volatile moments if you want to be around for the opportunities later, especially if these structural weaknesses are still lurking.
Couldn't agree more. And think about the catalysts and winners again. We saw complex things, huge geopolitical fears, sophisticated institutional liquidations driving the start. The mechanics involved cross-margin, complex stablecoin loops. But who won big? Either suspected insiders with that uncanny timing, or just individuals who managed to grab those split-second, completely broken prices like IOTX near zero. So it leaves you with a really interesting question to think about. In this high-tech algorithmic market, what ultimately decides success? Is it insider knowledge? Is it complex protocol design? Or is it sometimes just having the cash and the sheer nerve to hit buy when the entire system momentarily breaks down?
A heavy question to ponder as you navigate these markets. That wraps up our deep dive into the 10-11 event. We'll catch you on the next one.